You wrote your first angel check and it went to zero. Or maybe you keep hearing about syndicates, but you don't know who to trust. You want to invest, but you're scared you'll miss out on the next stripe. People ask me all the time, how much do I really need to start angel investing? Some people think it's in the millions of dollars. Some people think you can just YOLO $1,000 in a startup and hope it's going to be a 10x. But the truth is, it's not only about the numbers, but more importantly about the strategy behind it. Because if you invest 10K with no plan, no portfolio construction, you might lose everything before you even understand what went wrong. But with the right approach, you can build a legit startup portfolio even if you're not writing six-figure checks. So whether you're just getting started or you've already written your first few checks, this video will help you level up. Because angel investing is not about guessing or guessing right. It's about having a strategy and keeping at it over the long term. But before we start, if you're serious about angel investing and want to learn more about the startup world, subscribe to this channel. I share a video here every week teaching what I've learned after investing in more than 100 YC startups. All right, let's start with the classic route, direct checks. This is what most people think about when they hear angel investing. So you meet a founder, he tells you his story, you like it, and you give him or her 5K, 10K. It sounds really simple, but actually it's not. Because to succeed with direct checks, you need three things: access, conviction, and a plan. Access, aka deal flow, is the hardest. The best startups don't inbound email you. If you're just an angel, no one really knows you, and the best founders, they want to go to the big funds. So how do you get access to the best deals? That's really where most angels go wrong, is they invest in the very small pool of people that they know personally. The second thing you need is conviction. But when you're meeting the founder face to face, the energy is so strong that it's usually easy to get conviction on bad deals. So what you actually need to learn is how to get conviction only on amazing deals and not get yourself infected by the conviction of the founder in front of you. This is the second rookie mistake that I see direct investors make, is they invest in everything just because they think the founder is nice. Third, you need a plan and you need to think more than one or two checks. This is also a typical mistake that I see people make. They're just investing in 3 startups and they think that's it. They haven't planned on how to build portfolio construction, so we'll come back to that in a minute. Here's the trap that I see over and over. People write 1 or 2 checks and they think they're in the game, but they're not, because without real access, they're picking from a bad batch. It's like showing up to a buffet blindfolded, grabbing a random plate and hoping it's Michelin starred. That's how people lose money. Not because they backed the bad idea, but because they never saw the better ones. So if you're thinking of going this route of writing direct checks, just know this: it's high conviction and high risk. It only works if you have a huge deal flow, not just your network and some good vibes. Now, maybe you're thinking, okay, that sounds really intense. I'm not ready, or I don't have the time to go out and chase this deal flow. In that case, good news. There's an easier way to get started. With a syndicate, you don't need to source the deal yourself. You're piggybacking on someone that has great deal flow that's sharing his deals with you. And often you get to participate with as little as 1 or 2K minimum investment per deal. It's not totally passive, of course, because you still need to do your own research and choose, but still you can sit back, relax, and invest. But let me be real with you. Not all syndicates are created equal. Some of them are managed by professionals with amazing networks who invest really, really well. Others, not so much. Just because someone has access doesn't mean they have judgment. And it's not because a deal is on a platform that it's a good deal. AngelList accepts every deal. So here's the risk. Syndicates have really exploded in popularity in the last few years, and today you have almost everyone and anyone that can build a syndicate. And as always, when the quantity increases, the quality drops. So before investing, please vet your lead, ask about how much money they're personally investing, what the fees are if there are some, what's their track record, what have they done before, because many people are just in here for the grift to take fast fees and make you invest in some terrible startups. Remember, just because a deal is online doesn't mean it's a good deal. That said, if you're able to select the right managers and the right deals, investing in syndicates can be a great way to put to work little amounts of money, get exposure through people's deal flow, without having to go out and do it yourself. But maybe that too feels like a little bit too much effort. So what if you want great diversification, but being totally passive? Well, let's talk about funds. Here's a myth: the best angel investors pick their own deals. Well, that's not true. Some of the best investors that I know, they don't choose anything themselves. They back fund managers with better access, better track record, and a system that works for them. Here's how it works. You write one check into one fund, and that fund is going to invest your money into 20, 30, sometimes 50 or 100 different startups. No cold email, no need to hear any pitch, nothing to do but give the money and wait. It's like buying into the whole poker table instead of betting on one hand at a time. Now, I know some people who hate that idea. They say, oh, but I want to be involved, I want to do it. And that's the classic mistake. It's exactly like the stock market. If you pick your own stocks, it's more likely that you're gonna underperform the index and you'd be better just owning an ETF, for example. I often say your investments is like a bar of soap. The more you touch it, the more it shrinks. The truth is, trying to handpick your own startups is like trying to build your own house. It sounds cool, but do you really want to be the one Googling at 2 a.m. how to fix plumbing when there's a leak? Sometimes it's better to let the pros do it, the ones with the experience that comes from investing in hundreds of deals, making their mistakes early, and building pattern recognition. Minimums vary, but very small funds start at somewhere around 5K per quarter, which is very, very accessible, and they offer you amazing diversification with zero time on your end. No need to chase deal flow, no need to watch any pitch deck, no need to pretend to be a VC in your spare time. That's exactly what my investors at Lobster Capital tell me. They're so happy that they know someone is working tirelessly to grow their money for them and they don't have to be involved at all. They followed me for a long time and know that I've made all my mistakes and learned along the way, so they trust me to make better judgments than they would. But whoever you back, the key is this: the manager should be investing alongside you, not just collecting fees. So now you've seen the three possibilities: direct checks, syndicates, and funds. But so how much do you actually need to get started? Let's dive in. But before, let's clear a few things. Those are not just common misconceptions, they're exactly the reasons why new angels lose money. Myth number one, you need millions to get started. Nope, you can just get started with $1,000 with a syndicate. So it's not about the amount of money that you invest, it's about where you invest and how smart you invest. We'll get into how that works in a minute. Myth number two, just find one great startup and ride it to the moon. That sounds heroic, but it's not a strategy. Startup returns follow the power law. One winner pays for 20 losers. We're going to talk about that in a minute as well. Myth number three, all angels are aligned with you. Some syndicate leads are amazing, others, they're just here to collect fees. I'll show you how to tell the difference. All right, now that we've cleared that up, let's move on to how much you actually need to get started. Harvard has over 40% of its endowment in private markets. Some other people say you should treat it like crypto and have maybe 1% of your net worth in startups. Anything in between works, and actually over 40% works as well. Whatever you're comfortable with and allows you to sleep at night. But here's what doesn't work. Putting 5K in your friend's startup and calling it investing. Like I said, startup returns follow a power law. So 1 or 2 winners will pay for 20 other losers. That's why diversification is not optional, it's the name of the game. So if you want to build your own angel portfolio with writing direct checks, I'd say you probably need at least 100K to make at least 10 investments of 10,000 each. That's the minimum viable portfolio. But of course, if you're going more passive through syndicates or funds, you can probably start with 5 or 10K and get exposure to dozens of startups. Bottom line, there's no magic number. Just make sure your portfolio is big enough and diversified enough to survive the harsh startup math. All right, we've covered the strategies, the risks, and how much to get started, but let me get real with you. I'll tell you exactly how I got started into angel investing and the mistakes that I made and what I wish people told me at the time. So how did I get started with angel investing? Well, honestly, I kind of stumbled into it. I was writing small checks in people that I knew or that I met around me in my direct network in Paris. So looking back, I was doing the typical beginner's mistake of only investing in my direct circle and so not having big enough deal flow outside of my network. If I could rewind and do it all over again, I'd do things differently. First, I'd start chasing better deal flow right away, especially here in Silicon Valley. Of course, I'd learn how to evaluate founders more than ideas, that's a typical trap at the beginning, and I would write memos for all of my investments, going through my thinking at the time. Lastly, I would diversify faster. My first 5 years, I probably made 5 investments, and I was thinking all of them would succeed. Spoiler alert, they did not. And so I would diversify much more and much sooner. Now, if I were starting again today from scratch with 25K, I'd probably find the best fund manager that I can see out there online with the best deal flow and the best track record and try to get in that fund for 25K. So here's the real takeaway. There's no magic number to get into angel investing, but there is a wrong way, jumping in with no strategy and no portfolio construction, no diversification. Start small if you need to, but learn fast and plan on invest over the long term. There's no need to burn all your cash in a few months. Because this game is not about chasing unicorn, it's about giving yourself enough chances and odds to find one. If you're just starting out, go out and build your reps. But if you're more advanced into this process, you might be interested in what I share in my newsletter. This is where I go deeper in startup investing and what I see happening into the YC ecosystem. You can subscribe in the description below. Now I'd love to hear from you. Where are you in your journey? Are you just thinking about getting started, or are you already writing a lot of checks? Drop a comment below. Thank you so much for watching this video until the end. Don't forget to hit the subscribe button, and I'll see you next time.